Today we are going to start our next topic, business finance. What is this business finance? Business finance is basically called sources of finance. Or we can alternatively say that business finance is the one which is needed to finance a project or business activities. Usually there are main two classifications of business finance. First classification is called equity and the second classification is called loans. Although there are different details in equity and loans, but these are the major two classifications. Apart from this, at times we have third classification, which is called hybrid. Hybrid is what? Hybrid is the one which is mix of equity and debt. Okay. So now what is this equity? First of all, we will discuss equity. Equity is basically simply it is called owner's investment. Now in a public limited company, in a stock market listed company, owner's investment is called ordinary shares, which a company is needed to finance its business activities. Now, how ordinary shares are issued? For example, when a company is going to issue its ordinary shares for the first time, and first time when it is issued, it is called primary market, or alternatively, it is called initial public offering. When a company is issuing shares for the first time, it is called IPO. IPO is what? IPO is initial public offering. We are issuing shares for the first time in the stock market. Now, what is the way to issue shares for the first time in the market? Whenever you are going to issue shares for the first time in the market, the first way is to use the services of commercial bank. Commercial banks are the normal banks in which you receive your salaries, where you have your simple current or deposit account, uh, which you use for your some normal transactions like pay order, internet banking, for ATM. This is called commercial bank. Company will ask the commercial bank to provide us services where depositors or shareholders, those who are interested to purchase shares of the company, will deposit their sum or they will deposit their bank draft, and along with their form in which they are going to mention that how many shares they are ready to or willing to purchase. Usually shares are issued in bulks. Bulk means what? Company is going to issue 500 shares, suppose at $5 per share. So you have to pay $2,500. Usually par value or nominal value is the base rate. Par value or nominal value is $1. Nominal value is $1. So 5 minus 1 is 4 is the premium. So $2,500 is what? $2,500 is the amount which a shareholder or a prospective investor will pay to the commercial bank, and a company will perform a draw in which they will issue shares. Maybe all the interested parties will receive shares, or maybe all not all the interested parties will receive shares, a few will receive shares. Means company has met his issued share capital. After meeting issued share capital, company will not issue further shares. The other way to issue shares is underwriting. Underwriting or underwriter is basically the one who is a dealer of shares, or the one who has specialty in selling shares or a specialist in selling shares. It could be an investment bank. It could be just a provider, brokerage house, who asks the company that we are willing to sell your shares and we can market your shares effectively. To whom they have the capacity to market their shares either to prospective shareholders, means number of people in the stock market, or they says that we have wealthy individuals in our contact, so we are going to make private placements. Private placement means what? Private placement means we are going to sell your shares to the rich individuals or wealthy individuals who are not interested in annual dividend, they are interested in capital gain, or they are looking for the long-term growth. So underwriter is the one who has a specialty in selling shares, private placements. Underwriter will charge their service fees for marketing of shares. Apart from this service fees, at times they make an agreement that they will purchase or underwriter will purchase unsold shares, and at times they already decide what would be the share price if a few shares will be unsold. Or at times investment bank or a underwriter purchases all the shares or purchases majority shares if they think that they have the capacity to purchase, and they evaluate the potential of growth in the shares. Because if it is an investment bank, underwriter is an investment bank, then they have different institutional investors as well. Apart from wealthy individuals, they have institutional investors in their context. Now, who are the institutional investors? Institutional investors are basically the bank who has deposit from the uh, different depositors. Institutional bank investors are the investment bank. Institutional investors are like pension trust. They are like unit trust, or we can call them any other leasing company, or suppose leasing company or insurance company. So they are basically whom they are the institutional investors. This is called what? This is called underwriter. Apart from this, when company has issued share first time, now company wants to issue share second time. Already companies has issued shares in the market, suppose 2 years ago, 3 years ago, 5 years ago. Now company needs more funds. So that's why company is issuing shares second time. When company is issuing shares second time, it is called secondary market. And when company is going to issue shares second time, it is called right issues. Right issues means what? Right issues means company is going to issue shares in 1:5 proportions or in 1:4 proportions. For example, 1 for 4. 1 for 4 means if you have currently 4 shares, then company will pay you, or company will give you one additional share at a discounted price than the market price. And why do we call it right? Because it is a right of an existing shareholder that whenever a company will issue new shares, existing shareholder will purchase shares at the reduced price from the company. But this offer is not for unlimited time period. After a certain date, there will be no offer of issue right shares. So that's why shareholder has the right or shareholder has the option to exercise the right up to certain date. Now in this case, shareholder will calculate two values. One is called theoretical X right price and the other one is called value of right. Suppose there are 5 shares at current market price is $4, so $20. Right issue, suppose it is 1 for 5, so company is issuing one right issue at, suppose at 25% discount, which means 75% of the $4, which is $3. So 1 multiplied by 3, $3. So the total value is 23 and total number of shares are 6 shares. Now we will calculate where theoretical X right price per share is equal to $23 divided by 6. So theoretical X right price is 3.833 per share. Now there is an alternative, sorry, now we will calculate value of right. Value of right is the difference between current market price and the theoretical X right price. So this is called what? This is called value of right. Value of right means what? Value of right means this is the benefit given to existing shareholder on each share. Because existing shareholders think that after exercise of right issues, my average price per share has reduced to 3.833. In fact, current price is $4. So we are telling the shareholder that you are not going to lose anything. We are giving you discount on each share. So that's why your average cost per share is falling. Suppose if there will be a new investor in the market, a new investor will purchase 6 shares and 6 shares are purchased at $4. So new investor will purchase for $24. And you being a right issue shareholder paid $23 for 6 shares. So you have a benefit of $1 against 6 shares. So if we divide 1 by 6, answer will be same 0.16667. So this is an alternative way to calculate the value of right per share. So this is called what? This is called right issue shares. Now, if a company is going to issue shares either through IPO or through, I would say, right issues, what would be the effect on financial ratios? Financial ratios or the chapter of the financial ratios is also relevant with the, or in fact is relevant with the business finance or sources of finance. When you are going to issue ordinary shares either for the first time or second time, first effect will arise on the financial gearing. Financial gearing is what? Financial gearing is basically the relationship between long-term debt divided by equity into 100. When you are going to issue new shares or you are going to issue shares second time as right issues, your financial gearing percentage will fall down. Where there will be decrease in the financial gearing, there will be decrease in the financial risk of the organization. So don't forget this fact that financial gearing and financial risk are related with each other. If one will fall down, the other will also fall down. This is called financial risk. So if a decrease in financial gearing leads to where? Decrease in financial gearing leads to decrease in financial risk. Where there will be reduction in the financial risk, there will be reduction in cost of equity or required rate of return of the shareholder because risk of the organization is falling. So It is a positive indicator if financial gearing of an organization is reducing. Apart from this, the second ratio which is relevant with the issue of shares is called interest coverage. Because you are going to issue shares and due to increase in shares, there will be no increase in interest expense or interest expense will remain changed. So it is expected that interest cover will rise due to issue of shares. Where there will be rise in interest cover, it is a positive indicator. Next one is called dividend cover. Dividend coverage is basically what? Dividend cover is basically the relationship between profit after tax and the dividend. Profit after tax divided by dividend. So if you are going to issue new shares, it will reduce your dividend coverage, which is considered as a negative indicator, or it will be considered as a negative indicator. Next, then we have another earnings per share. Whenever we are going to issue shares, earnings per share is equal to profit after tax divided by number of total shares or number of ordinary shares. So if you are going to issue more shares, your earnings per share will fall down. So this will be the negative impact due to issue of ordinary shares, and here we will have positive impact, reduction in the financial gearing and rise in the interest coverage. Interest coverage is equal to profit before interest and tax divided by interest expense. Remember one more thing, whenever we are not going to multiply with the 100, it means we are not going to calculate percentage, we are calculating times. So we are calculating times interest cover times it as well as dividend coverage time. So this is called what? This is called effect on the financial ratios due to issue of ordinary shares either through initial public offering or through right issues. Any question? Next one is called bonus issues. What is this bonus issue? Bonus issue is the one a company is going to issue additional shares. Right issue is also the issue of additional shares. But in the right issues, company will receive cash. Here, company is not going to receive cash. Apart from this, these are also issued in proportion. Suppose 1 for 4. 1 for 4 means if you have currently have 4 shares, there will be 1 bonus issue. So this is called what? Bonus shares or bonus issues. No cash is received for the company. Basically, bonus issues are issued along with the cash dividend. Company is paying dividend, but cash dividend is not enough. So that's why company thinks that it can annoy our existing shareholders and maybe possible as existing shareholders will respond adversely. So company will not be able to bear this adverse response. So that's why they are going to issue new shares from their existing share premium. They will reduce this amount from their share premium and they are giving an opportunity to the shareholders to sell their bonus issues or bonus shares in the stock market at a market price and make or earn dividend for you. This dividend is called homemade dividend, where you are selling bonus shares in the market, which will help you to generate cash or cash dividend. So, along with the small or little amount of cash dividend, company is going to do what? Company is going to issue new bonus shares or new shares which are saleable at which no price, but shareholder has the opportunity to sell those shares at the reduced price in the, sorry, at the market price in the market, and can earn dividend for themselves or can make dividend for themselves. Bonus issues is also called scrip issues. It is also called scrip issues. Next one is scrip dividend. Scrip dividend is also like bonus issues, but here no cash dividend. Previously, we were saying in the bonus issues that there will be a little amount of cash dividend, but here we have no cash dividend. No cash dividend means what? No cash dividend means only additional shares. Only additional shares. For example, 1 for 5, which means what? We will issue one additional share in compensation of 5 shares, 5 existing shares. Again, shareholder has the opportunity to sell additional shares at market price and earn dividend for themselves. This is called what? This is called homemade dividend. Just like bonus issues, but here we have no cash dividend, and it is not called scrip issues or bonus issues, it is called scrip dividend. So please do not club bonus issues and scrip dividend with each other, or scrip issues or scrip dividend with each other. Scrip dividend is something else and bonus issues is something else. So this is called what? This is called the shares or equity. So here we have what we discussed, the ordinary shares, that ordinary shares are issued by the organization for the first time. It is called IPO. Then we discussed that what is the right issues, what is theoretical X right price, what is value of right. Then we discussed bonus issues and as well as scrip issues. After the issue of ordinary shares, the next topic is preference shares. Any question, anyone? Preference shares. Why do we call them preferred or preference? They have preference over ordinary shareholders. When at the time of dividend payment or at the time of liquidation. So that's why in the profit and loss account, from profit after tax, first we deduct preferred dividend. After that, we have profit for ordinary shareholders, less dividend for ordinary dividend. Then we have retained earnings. So profit after tax less preferred dividend, we have profit for the ordinary shares. So preference shares are the one who have preference over ordinary shareholders at the time of dividend payment or at the time of liquidation. Preference shares are issued with fixed dividend percentage. Fixed dividend percentage is basically the characteristic of a loan. But here we have two types of preferred shares, or in fact, first we will discuss two types of preferred dividend. One is called cumulative and the other one is called non-cumulative. Cumulative means what? If company could not pay dividend in the first year, then company will pay dividend for the 2 years in the next year. Non-cumulative is the one if company could not pay dividend in the 1 year, in next year company will not pay the dividend for the 2 years. So this is called what? This is called fixed dividend. Another characteristic is either preferred shares are redeemable. Redeemable means company will buy back preference shares at predetermined price, which could be par value. Maybe par value is $1. Maybe par value is $0.5. Maybe par value is $0.25. Whatever the par value is. Or at premium. Suppose at 5% premium, at 5% premium. Par value could be $100. This is called redeemable. Redeemable is the characteristic of loan. That's why this case we will treat it as a non-current liability in the stock or in the financial gearing. Or it is also called prior charge capital. Prior charge means fixed rate of interest is charged on this capital, which is called redeemable preference share, which is called loan notes, or which is called bank loan. The other type of preference shares is irredeemable. Irredeemable preference share. Irredeemable preference share is what? Irredeemable preference share is the one where it is expected that there will be no redemption of the preference shares. Once company has issued, company will not buy back their shares. If you want to withdraw the investment from the stock market or from this company, you have to sell these shares in the market, but company will not buy back. Only company will pay fixed dividend percentage. Its market value will vary. So irredeemable is what? Irredeemable is characteristic of equity. Convertibles. Convertibles are the one where we are giving an opportunity to existing shareholders, existing preference shareholders, that they can convert their preference shares into ordinary shares at redemption date. If we issued preference share for the 5 years, we will give you fixed dividend for 5 years, and at the end of fifth year, you can convert your preferred shares into ordinary shares at predetermined proportion. For example, 20 ordinary shares against one preferred shares. So this is called what? This whole is called preference share. Any question related to preference shares? After this, after preference shares, we have the next topic, which is called loans. Now there are different types of loans.